Good evening, traders. Today is Sunday, January 12th. Let's do our portfolio review and look at market first as usual. So on Friday it was a big market decline. If we check it from beginning of previous week, market dropped more than 200 points. It's lower than was low before, and volatility when went up to around 20 from 16 approximately, so 4 points up. So my portfolio is down from January 1st for this year, approximately 1.52%. I hope you have not more than that also. Uh, we don't know what market gonna do next week. Probably it could go lower. Let's see our portfolio and each trades and check who is the first candidate for roll next week if market decline will continue. So this is as usual our total position of ES futures. It's not bad. It's still good shape structure. You see that we decline a little, but I don't think it's gonna be too bad for our portfolio. We will continue to adjust it if we need, and our hedges plus theta will allow us to build good base to go up again sooner or later when markets start bouncing up and get more profit from our portfolio. Now let's check what kind of positions we have, where our risks. The first and most important thing probably it's our Vega hedge, which has a one naked put, which is now just 14 days till expiration, and it's reached delta 20. It's time to do something with it. What we can do here? First of all, because total our Vega hedge position is positive in profits, approximately still $400. I think that we can just close that short. We didn't lose much from it. My Option Net Explorer shows that total loss of this naked put just 8 points, so it's $400. So we can close it. Let's see how it's gonna look like. Yeah, it's gonna look like a perfect Vega hedge. Or if you want, by the way, if we close it, we will not just take out risk, but also probably increase our very important margin requirement, reduce margin requirement, and make it better and reduce our total portfolio delta. But if you want, you can roll it to somewhere 30 DTE back to delta 10. If we do that, let's see how much debit we're gonna have. Let's say that one 54.50 strike. We're gonna get small debit, just 3.6. We even don't need to take out some credit from our hedges to compensate that because it's too small, 3.6. It's up to you. You can do it if you don't have issues with margin. You can just roll it to February 25th, 31 DTE to strike 54.50. So it's your choice. I will probably close it and wait till market will stop dropping down, and when we're gonna open next tranche of our Vega hedges, we will maybe add one short 30 DTE put again. Next, let's see our A ladder, how it's look like. Well, I don't see much risk here. Our short is 21 DTE at delta 10, so it's absolutely not risky. We're gonna probably hold it because volatility expand and it's pretty expensive, cost about $15 right now. Let's wait till it will cool down and get some more profit from theta, and after that we will convert it the same way as we did with ladder B to our new calendar delta hedge strategy, CDH. Let's see now ladder. We won't check B because we converted. We will talk about it later. Let's check ladder C. It's also not too bad. Our shorts are 28 days till expiration, and at delta 9, so also very safe. We're gonna keep probably week or two, unless market will bounce up and it will be extremely cheap. We will also convert it to new CDH strategy. I think that ladder D is a little bit worse because it was the last one which we roll, and short should be at higher delta than any other ladders. Let's see what we have here. It's also 28 DT. Our short, yes, it's at delta 15. So if the market continue go down and our naked puts will be at delta 20, as usual, we will roll them probably out because it's less than 30 DTE, and to delta 10. If it's gonna be roll with debit, we will get some credit from our hedges as usual. What else do we have? We have our balalaika trade. Let's see how it's look like. We have in our balalaika trade two expirations of naked put. One of them closest at 42 DTE. It's not bad, it's 12 delta 12, quite safe. But another one which is 56 DTE, it's much higher, it's 16.5 delta. So again, if market continue go down and this naked put will be at delta 20, we will roll it down this time because it's long term, it's 56 DTE. We will roll down at the same expiration to delta 10. It's gonna be definitely with debit, but we have pretty good hedges here. We have one vertical and two just long puts, which is extremely hard hedge, and we will see which one we're gonna use. We can close our vertical and keep just two longs, or we can roll our longs a little bit down. Let's wait and see which one will be appropriate in that case. we have also? We have three violin strategies. V6. I don't see any much risk here. Our shorts is at 21 DTE, delta 10, so it's quite safe. So I doubt that we're gonna need to roll it unless it will be huge move down. V7, it's a little bit worse because it's new, and can we see that this structure is negative right now, approximately minus $600. Let's see where's our shorts. It's 49 DTE and at delta 17.5. This guy should be rolled down for sure if market won't bounce up. So what we're gonna do here, we're gonna roll it down to delta 10 and take some profit from our delta hedge by rolling our longs at least 100 points down and see if it will compensate our debit, naked put debit roll. Also, we have violin mini, which was converted to regular violin. This is how it's look like now. Our naked put is 35 days till expiration. It's safe, it's about 11 delta, much safer than Vega 7, so we're gonna hold it, and if we need it, we will do the same thing. If it will hit delta 20, we will roll it to delta 10, probably the same expiration, or maybe add a couple of weeks to that, and compensate it by rolling our longs of our hedge, probably 100 points down. Now let's talk about our new trade, which is CDH, which we open as a hedge. You can see it here, it's hedge itself. It shows approximately 400 in profit. It's quite soft because it's long term. Don't expect that it will give you huge profit with small or regular kind of decline. It will accelerate later if market continue to go down. I hope without huge expansion of volatility. Even with expansion, it should be okay. But our naked puts is under pressure because we open it right before market decline. So right now it shows about 1500 loss. So altogether with our CDH, it is about $1,000 loss. But don't forget that we have to check this position with our remaining hedges of our B ladder strategy, which we convert from. So if we check it with B ladder, it's not too bad. Let me change it a little by expiration. This is how it looked like with all B remaining hedges. We are at delta 5.6 now, have 53 theta, negative Vega. So it's not too bad. So we're gonna hold it until we get, if our shorts will be at delta 20, we will start rolling them as usual. But now it's not too bad. If guys, you open this position without existing remaining hedges from ladder B, you should open CDH, not just one, but at least two, and maybe even three of them. So if you do two, your loss should be about $500 right now. If you open three, it's gonna be around zero. So it's not bad trade, and believe me, we will get something from that sooner or later. What else I would like to talk about? It was questions in Discord channel about my. Oh, first, sorry. Let's talk about our MES position. Forget that we have also MES position. Can you see with MES we have three different expirations. One of them, which is only 21 days left. If you remember, when we open new expiration, we close three cheapest naked puts of this one, and now it's even much higher than our tail profit, and it's exactly why we hold it, because when we open new expiration, we're expecting that this expiration, which is just 21 days, will additionally protect it, because can you see it has a negative 16 delta. So if market continue go down and we're gonna lose from our new, which will open on Monday, MES expiration, at least we're gonna compensate with additional profit from this one. So this is how our new one look, and it shows about 8,700 profit, but I just would like to remind that it is a ES, because OptionNet Explorer don't have data for micro ES, so we have to do it in ES, our structure of MES. You just need to divide it by 10, so it's approximately $870 in profit. It's not bad. If margin of this structure approximately $3,000-4,000, so it's kind of 25% profit. The second one, which is right now at 42 days till expiration, it's also pretty safe. We're just approaching our highest long. Our profit shows, by the way, close to tail profit. It shows about $200 in profit. If it's continue go down, we start adjusting it, probably roll down our highest long somewhere 57.50 maybe plus one, and at the same time we will roll down our closest short. We have three at 5,500. We will roll it probably somewhere at 5,400 maybe, and this way we're gonna have six of them at that strike. So if you, by the way, this kind of adjustment we're still gonna do with credit. That means that our structure will be safer, but at the same time our tail profit will be higher. That's how it's gonna be if we do that roll. But we hold for now. We will see what market gonna do. And the third one, which we opened just on Monday, it's the newest one, of course, after this kind of decline and volatility expansion. It shows $177 in loss. We hold on, we will see. I won't add anything on Monday unless market will bounce up. And I would like to show you all three together just to see how it look like. It's much better. This is how all three of them together shows 9,000 in this case, but in true life for mass it's $900 in profit. That's how our structure look like, with small debit, with small delta about 3.5. Also we have oil position, which actually I forgot about, and probably it need to be closed. It's now already 35 days till expiration, and we virtually reach our tail profit, which we plan to get about $500, but now it's 462. It's up to you guys. Next week you can close it. Should we open new one? It depends of your margin, portfolio margin. I will wait because I see that market oil is went up too much. If we open it and it's go down again to the same range, it will, our new position will be under pressure. So probably we're gonna hold it till we see that decline, and after that open new tranche. Our TLT position, yeah, it's terrible one. You know how our how TLT dropped down. It's already approximately approaching 55. Well, yeah, it's probably the only position in our portfolio which give us a negative number, but you shouldn't have, first of all, big position. We only 200 shares long, and I think that it's overreacting, and we will see some kind of stop or bounce up, and of course we will continue to sell against that short calls and some short puts to make that 200 shares of TLT less expensive. And don't forget that we will start getting dividends from that, which is equal right now approximately 5.5% per year. Now I would like to show you guys my hedge, which has some questions. If you have my hedge course, you should be familiar with that. It is, I was discussing this there. It's a calendar ratio hedge. This is how it's look like. Usually we open it when we need to cut our portfolio delta, because this structure has a pretty big negative delta, and if our portfolio delta approaching 0.3%, which is max, which we would like to have, we can add this kind of structure to cut that delta down. You can see it's a pretty good strategy to additionally protect our portfolio. Setup is we usually buy two longs at approximately 60 days till expiration at high delta, approximately delta 30, 25 in this range, and sell against it 5 puts long term 120 DTE at delta 5. So, and this is how it's gonna look like. How we're gonna adjust it? Well, if market continue to go down, we will probably lock some profit by rolling down our longs, or we can reduce position by closing one long and one short. I'll show you how it's gonna look like. If, for example, our position will be in profit, we'll roll down that two longs. And increase that line up, and log that profit, or we can do even better. We just close one long and close one short, and in this adjustment our strategy will look like this. Can you see it? It will be virtually no loss from upside and still hold some small potential for as a hedge to downside. The same thing we're gonna do if market start going up and we think that risk of big market correction is over. We can do the same thing, and probably it will be in small loss. If we do this adjustment, we will wait maybe a week, a couple of weeks till we will get a break even and close that position completely. But now, so far, it serves us as additional portfolio protection with pretty good negative delta. It shows right now about 11 negative delta, but it's SPX. For SPY it's 110. So yes, it's reducing our delta, portfolio delta, plus give us additional portfolio protection. That's it. What else I would like to talk about? Lots of you got my new training course, which is CDH. We have right now 95% off, which I plan to keep at least for one more week. For new people who would like to join our Discord, I just would like to say that this course and this discount, for sure, it's available only for premium member of our Discord channel. If you would like to get that course, it's very important, a very good one. You should join us as soon as possible. By the way, if you join our Discord channel, you can get 50% off for the first month. So altogether, you can get first month of Discord channel membership plus the course altogether for €75. It's a good deal, and in 1 week I'm gonna close that deal completely. So if you would like to join us, you have a 1 week window to do that. Thank you very much. I hope you having good weekend, and let's see what next week gonna give us. Thank you very much. Bye, guys.